As of the market close on Friday, June 5, 2026 at 4 p.m. Eastern Time, Lucid Group Inc. settled at a price of $5.12 per share, marking a punishing 9.95% drop during the final trading session of a highly volatile week. If you look at the total weekly performance, the destruction is even more apparent, with the stock collapsing roughly 22% over the 5-day period. This staggering slide pushed the luxury electric vehicle maker right down near its 52-week low of $5.09. While the broad market narrative points to macroeconomic pressure following an unexpectedly hot United States employment report, which effectively crushed investor hopes for near-term Federal Reserve interest rate cuts and hit capital-intensive growth names across the board, the true story underneath is far more micro-driven, complex, and urgent. The sudden drop hides a much deeper structural shakeup that completely upends the thesis for anyone managing an individual brokerage account or picking individual automotive equities. The immediate reality that completely blindsided retail investors this week was an abrupt, unannounced transition right at the very top of the executive suite. On June 1st, Lucid unexpectedly announced that Silvio Napoli was taking the reins immediately as the chief executive officer. This development shocked the market because the company had previously set a different leadership timeline back in mid-April. What makes this leadership change so critical and frankly concerning is the immediate context surrounding the company's operational rhythm and severe balance sheet constraints. When an early-stage manufacturer switches leaders with zero transition buffer, it usually signals intense internal pressure rather than an orderly strategic handoff. This sudden change forced institutional desks and casual retail players using self-investing methods to immediately reevaluate the company's underlying stability. The common ground among most market participants has long been that Lucid possesses some of the most advanced, highly efficient electric vehicle powertrain engineering in the world. Investors look at the industry-leading driving range of the premium Air sedan, which can clear 500 miles on a single charge according to official environmental ratings, and assume that world-class engineering eventually guarantees commercial viability. People scanning popular investing sites or seeking professional investment help often believe that if a product is technically superior to a standard Tesla stock offering, the financial details will eventually sort themselves out. There is a widespread expectation that the backing of massive institutional players and foreign sovereign funds guarantees an infinite runway for the brand to eventually find its footing in the global luxury market. However, the harsh reality challenges this optimistic view, forcing us to rethink the entire narrative. Exceptional engineering means absolutely nothing if a company cannot manufacture at scale or control its cash burn. The expectation was that by mid-2026, production efficiencies would kick in, reducing losses per vehicle. The reality is that the operational metrics remain deeply troubled. During the first quarter of 2026, the automaker managed to deliver only about 3,000 vehicles worldwide, a drop in the bucket for an assembly infrastructure built to handle far more volume. Because of this sluggish sales base, the financial bleeding has reached extreme levels. Over the last 12 months, the company's free cash flow sat at a negative $4.6 billion, a staggering burn rate that completely overshadows its actual commercial revenue. Let us look closely at the trading mechanics and institutional behavior observed during Friday's dramatic slide. The trading volume exploded to over 24.5 million shares, which is nearly double the ordinary daily average of roughly 11.8 million shares. When a stock drops 10% in a single day on massive accelerated volume, it tells you that major institutional holders are actively dumping blocks of shares rather than casual retail accounts executing minor adjustments on a mobile app. Professional portfolio managers, the types who control large allocations across major Fidelity Investments accounts or interactive brokers trading setups, are clearly rebalancing away from high-beta, unprofitable automotive startups. This heavy institutional distribution creates a massive structural overhead that makes a quick price recovery incredibly difficult without a monumental shift in fundamental performance. The pressure on the stock is further amplified by significant legal headaches that began intensifying throughout the week. Multiple prominent securities law firms announced or renewed class action claims against the luxury EV manufacturer and its top executives, alleging violations of federal securities laws between late February and mid-April of this year. While retail investors often ignore legal notices scrolling through active investing platforms, institutional compliance departments view these developments with severe caution. Ongoing securities litigation increases corporate governance risks, threatens to drain management's focus during an existential operational pivot, and presents an unquantifiable future financial liability. For large funds utilizing comprehensive wealth management services, these escalating legal risks frequently trigger automatic sell signals to protect client capital. The timing of this operational crisis is particularly brutal because the broader macroeconomic environment has turned intensely hostile toward pre-revenue and unprofitable capital-intensive businesses. Friday's strong macroeconomic data showed that the domestic economy added far more jobs than Wall Street anticipated, which signals sustained inflation resilience. Consequently, fixed income yields spiked, and expectations for any imminent Federal Reserve rate relief evaporated. For an established titan like an Apple stock or an Nvidia stock, a high-rate environment is a manageable hurdle because they generate billions in organic free cash flow. But for a business that relies entirely on external capital to keep the lights burning, elevated interest rates mean that any future debt or equity issuance becomes painfully expensive and highly diluted to existing retail investors. To understand how precarious the current position is, we have to look directly at the cash balance reported in the latest quarterly filing. At the end of the most recent financial period, the company held just about $700 million in cash on its balance sheet. Given a trailing annual cash burn that exceeds $4 billion, that remaining liquidity is terrifyingly small. Management did manage to secure a critical lifeline by pulling together a combined $1 billion in emergency capital from strategic partnerships, including commitments from global technology platforms and their primary sovereign wealth backer. However, even with this fresh capital injection, the financial runway remains incredibly short. Analysts tracking the numbers closely on advanced interactive brokers platform applications calculate that the business is still at risk of running completely out of liquidity before the conclusion of this calendar year, unless capital expenditures are dramatically slashed. Comment below how many shares of Lucid Group Inc. you currently hold, or if you are entirely avoiding the electric vehicle sector in this current interest rate environment. Your feedback helps track retail sentiment in real time. Now, let us ground this analysis by looking at the core business model and how the company reached this highly pressured crossroads. Founded initially in 2007 as an advanced battery maker supplying components to professional electric racing series, the organization eventually transitioned into a full-scale automotive original equipment manufacturer focused squarely on the premium luxury tier. Their primary production facility located in Casa Grande, Arizona, represents hundreds of millions of dollars in fixed capital investment, designed to scale up to an annual output of over 100,000 units over time. The business model relies on maintaining complete in-house control over their proprietary electric motor design, battery pack integration, and software architecture, allowing them to market vehicles that boast unparalleled electrical efficiency and performance metrics. The commercial rollout began in late 2021 with the ultra-premium Air sedan, a vehicle praised by automotive journalists and winning major industry awards for its incredible engineering achievements. The product lineup gradually expanded to include more accessible trims, lowering the initial cost barrier to attract a wider luxury audience. Following the sedan, the company initiated the initial production phases of its long-awaited luxury sport utility vehicle, the Gravity, in late 2024. The luxury SUV segment was supposed to open a massive high-margin revenue stream that would balance out the slowing global demand for premium sedans. Furthermore, the company tried to diversify its revenue model by entering technical supply agreements with legacy luxury marques, providing advanced electric powertrain components to brands like Aston Martin to generate high-margin licensing fees. Despite these technological achievements, past financial performance reveals a persistent, compounding mismatch between theoretical corporate guidance and actual factory execution. In 2022, initial production was crippled by severe logistics bottlenecks, resulting in just over 7,000 units rolling off the line. While 2023 saw production rise slightly to 8,428 vehicles, the financial statements continued to look highly unsustainable. By the end of 2024, annual revenue sat at a modest $808 million, while the net loss for that same 12-month period surpassed a staggering $3.06 billion. This means that for every single luxury car the company built and delivered to a customer, it lost hundreds of thousands of dollars on a structural basis, a reality that explains why the stock has disintegrated from its historical highs to its current single-digit stress territory. Looking forward, the future outlook for the company depends entirely on a high-stakes race between product expansion and cash preservation. The most critical near-term catalyst is the full commercial scaling of the Gravity SUV throughout the remainder of 2026. If the new leadership can successfully accelerate factory output without hitting quality control issues or additional supply chain blocks, the company could potentially see a dramatic spike in automotive revenues that helps offset their fixed overhead. There are also early strategic discussions regarding a future mid-size platform designed to compete directly against mass-market models, which management believes could scale production volumes into the hundreds of thousands by the late 2020s, though that requires billions in capital that the company does not currently possess. Another fascinating future catalyst keeping institutional investors engaged is the company's emerging footprint in the autonomous vehicle and ride-hailing space. Recent industry disclosures indicate that global technology networks are committing significant capital to autonomous delivery and robotaxi startups like Nuro as part of a multi-party strategic agreement. This plan outlines a vision to eventually deploy thousands of autonomous vehicles utilizing custom platform configurations based on the Gravity SUV chassis. If this autonomous ride-hailing narrative gains actual commercial traction, it could transform the brand from a struggling niche automaker into a primary hardware supplier for the next generation of urban transportation networks, a thesis that currently acts as the absolute floor, preventing a total collapse in long-term investor sentiment. However, the downside risks to this future outlook are exceptionally high and must be weighed carefully by anyone utilizing self-investing strategies. The absolute biggest threat is an immediate liquidity crisis. If global capital markets remain restrictive and high interest rates persist, the company will have to continuously issue highly dilutive equity blocks just to keep its factories running. This constant dilution acts as an anchor on the per-share value, meaning that even if the business survives operationally, early shareholders could see their ownership stakes severely diminished. Furthermore, the global luxury electric vehicle segment has become hyper-competitive, with legacy European luxury brands and established domestic leaders discounting products and fighting aggressively for a pool of affluent buyers that appears to be shrinking due to shifting consumer preferences. In summary, the central insights of this detailed